January 27th, 2025. One ordinary morning, $593 billion gone. Not lost in war, not stolen in a scandal, just wiped out from a $6 million worth of code written by a team most of Silicon Valley had never heard of. Nvidia, the most valuable chip company on Earth, didn't get beaten by a bigger chip. It got beaten by a tiny piece of code, and Wall Street still hasn't recovered from the shock. Here's what they're not telling you. Before we go further, you need to understand what was built, what it cost, and why the people running trillion-dollar companies are quietly terrified right now. Subscribe before we go deeper, because once you see this pattern, you will start noticing it in every market, every sector, every bubble. It's that fundamental. During the gold rush of the 1840s, the people who got rich weren't the miners, it was the guys selling the shovels. That's exactly what Nvidia did with artificial intelligence, except instead of shovels, they sold H100 GPU chips at $40,000 a piece, and every major tech company on Earth was lining up to buy them. Google, Microsoft, Meta, Amazon, all of them brilliant, billion-dollar companies, completely dependent on a graphics card manufacturer from Santa Clara to power the future of human intelligence. By early 2025, Nvidia's market cap had crossed $3.3 trillion, larger than the annual economic output of an entire nation like the United Kingdom. Let that sink in. A company that 15 years ago was primarily known for making your video games look pretty. Wall Street didn't just like Nvidia. Wall Street needed Nvidia. Hedge funds built their entire AI thesis around it. Pension funds piled in. Retail investors maxed out their brokerage accounts on Nvidia ETFs. The stock had returned over 800% in 3 years. Analysts were calling it the backbone of civilization's next chapter. Jensen Huang, Nvidia's CEO, became a rock star. His black leather jacket became a symbol of inevitability. But here's the question nobody on Wall Street was asking. What happens if the backbone turns out to be more fragile than anyone realized? Let's talk about where Nvidia's money was actually coming from. Venture capitalists were flooding billions into AI startups. Those startups, to look credible, to demo their models, to compete, were spending up to 80% of that cash buying Nvidia chips. That's where the demand was coming from. Not consumers, not businesses generating real revenue. Startups burning investor money to rent computing power. But it gets more circular than that. Goldman Sachs analysts quietly flagged something alarming. Nvidia wasn't just selling chips to these companies, it was investing in them, committing up to $100 billion into OpenAI, backing CoreWeave, funding Iron. And what did those companies do with Nvidia's money? They bought more Nvidia chips. Jensen Huang called it prudent ecosystem investing. Critics called it something else, a hot potato scheme. A closed financial loop where the same dollar bounces between Nvidia and its customers, each time inflating the revenue numbers and the stock price a little more. Does this remind you of anything? Cast your mind back to the year 2000. Cisco Systems, the Nvidia of the dot-com era, was selling the shovels of the internet. Routers, switches, infrastructure. Their stock hit $80. Then the bubble popped. Within 2 years, Cisco was trading at $11. It is never fully recovered. History doesn't repeat, but it rhymes loudly. And here's what's even crazier. The thing that finally broke the illusion wasn't a government investigation. It wasn't a whistleblower. It was a group of engineers in China who decided to publish their work for free. And what they published made $40,000 chips look like a very expensive mistake. What comes next is the part the financial media buried in the fine print. You want to subscribe because this story is far from over. January 20th, 2025. A Chinese AI lab called DeepSeek releases an open-source model called R1, and it matches GPT-4 on almost every benchmark. That's impressive, But not the shocking part. The shocking part, they built it for approximately $6 million, in a world where OpenAI had burned through billions, in a world where Google had spent years and entire data centers training comparable models. A small team, working under US chip export restrictions, meaning they couldn't even access Nvidia's best hardware, built a world-class AI model for less than the cost of a Manhattan penthouse.
Think about what that means with a simple analogy.
Imagine you spend $1 million on a Ferrari because someone tells you it's the only car fast enough for the road ahead. Then, someone releases a software update, free open source, that makes a Honda Civic run at the exact same speed.
That is what DeepSeek did to Nvidia's entire business model.
The mathematical panic was immediate. If AI companies can achieve the same output using 90% fewer chips, Nvidia's demand pipeline doesn't slow down, it collapses. The $40,000 H100, suddenly very hard to justify. On January 27th, Nvidia's stock dropped 17% in a single day. $593 billion in market cap erased. Some leveraged Nvidia ETFs lost 51% in 24 hours. And then came the geopolitical gut punch. At its peak, Nvidia controlled 95% of China's high-end chip market. By 2026, Jensen Huang himself acknowledged that share had collapsed, effectively to zero. Chinese companies like Huawei had pivoted to domestic chips. DeepSeek's efficiency breakthrough meant they didn't need American hardware anymore. Domestic alternatives now hold 41% of China's AI accelerator market. And in a final twist of irony, the US government approved selling Nvidia's powerful H200 chips to 10 Chinese companies in 2026. Not a single delivery was made. China refused to buy them. The empire didn't just lose a customer, it lost an entire continent. And the worst part? The cracks don't stop there. According to a 2026 Globalization Partners report, 73% of executives admitted that AI output has failed to meet their expectations. Nearly 3/4. And the response? 70% of businesses are prepared to cut their AI budgets entirely if the technology doesn't start generating real, measurable returns. The consumer revenue that was supposed to justify all of this spending, the revenue that Nvidia's entire $3 trillion valuation was predicated on, hasn't arrived. Big tech promised shareholders a revolution. They borrowed billions to fund it. They filled data centers with chips at $40,000 a unit. And now, 44% of global executives actively expect the AI bubble to burst in 2026. This isn't just about Nvidia's stock price. This is about corporate debt. Companies that borrowed heavily to buy AI infrastructure are now sitting on depreciating assets with no clear revenue stream to service the loans. If those companies start cutting losses simultaneously, the sell-off doesn't stay in the tech sector, it spreads. That is how bubbles become crises. But sure, maybe this time is different.
Nvidia built the infrastructure for the future. But what if, beneath it all, they had built a house of cards?
Because on January 27, 2025, the first gust of wind hit it. $6 million of open source code, written by engineers who couldn't even buy Nvidia's best chips, exposed a $3 trillion illusion. The question isn't whether the cracks are real. The question is, how deep do they go? We've seen this movie before. Massive hype, explosive growth, promises of a new era. Comment revolution or bubble. I'm curious where you stand.